Jerome, let's start with you. In terms of just the backdrop here, we await yet another crucial monthly CPI number tomorrow. The markets seem to be gaining comfort with this idea of a soft landing, inflation getting some downside momentum, and then maybe the Fed's ultimate destination being within sight. Now we're rethinking it. Maybe the economy looks firmer. How would you characterize the outlook around those issues right now?
Yeah, we're going to see a lot of data dependency still remaining in the market, as well as the Federal Reserve. It's really too early to declare and wave a victory flag with regard to the soft landing. There's admittedly some issues that are going to be, continuing to be evolving in terms of the inflation outlook. We still foresee at PIMCO a 3% core CPI as we end 2023, so it's still elevated beyond the FOMC's current comfort zone. But I think what it ultimately leads to investors is a bit of uncertainty, leading to thinking about, more importantly, how to insulate portfolios to the uncertainty that we see, both in terms of the earnings outlook, but also the volatility we see in the marketplace. Just look at what's happened over the past 4 weeks of trading. We've had rates rally, rates sell off, all things corresponding to the uncertain outlook between and the divergence of market views between the market itself and the Federal Reserve. And that in and of itself creates a little bit of confusion, but also opportunity. So as we seek the Fed to provide more clarity in terms of where their outlook's going to be, in terms of the FOMC and the dots that we'll see later on in March, for investors right now, we have to be really looking at how to think about sectors and allocation in terms of portfolios, and insulating those portfolios to the outlooks which may not necessarily be 100% convinced that the soft landing is here at hand. That's how investors should be playing about it and thinking about it over for the next few quarters.
James, I mean, how much of the macro expectations filter into your process? I mean, what do you have to assume when you're going in terms of looking at what makes sense to own right now?
No, I mean, 100% we have to take a look at all the macro factors, right? And look at what's driving bond yields, bond credit spreads right now. I mean, to Jerome's point, we think that there isn't a high enough likelihood priced into credit spreads in the front end of the curve right now that there is a harder landing potentially to come. And so we've seen credit spreads rip tighter here to start the year. I think that we're a little cautious on that. So at the moment, we're taking in, obviously this idea that maybe the macro is a little leaning a little bit more towards softer landing than we had even thought to start the year. But with that being said, valuations are very tight right now and look a little too rich for us. So we're taking a little bit more of a conservative approach here.
So you're suggesting valuation's a little rich, so spreads are a little too tight to compensate you for the possibility that we do get a harder landing?
Certainly, yeah. And then certainly in some sectors and individual names, essentially, yep.
Todd, a broader picture in terms of the asset class right now. I mean, I was joking coming into the year that for a generation of investors, there's this massive novelty value in the fact that there's 4.5% pretty safe yield out there in the world. And so you've seen the money follow in that direction in terms of people trying to capture some of that. How is that playing into the, I guess, aggregate portfolio construction here? It's people aren't necessarily betting on lower rates to come or a dovish Fed. They're just almost using the yield as a buffer for the rest of their portfolios.
Right. So there's now income within the fixed income ETFs that are available. We had $26 billion in January alone. That's coming off of nearly $200 billion of net inflows into fixed income ETFs in 2022. But what we're seeing is investors are taking on yield. So we've seen higher quality investment grade corporate bond ETFs. We've seen high yield fixed income ETFs see inflows this year, as well as some of the safer products. So there's a mixture. Some folks are moving into a product like JPST for the relative safety, but they're also going into a product like HYG, which is a high yield bond ETF from iShares, to get a mixture of exposure, a barbell approach, some risk on, some risk off, and being able to balance their portfolio to get a ballast as opposed to what you had within just equities. People were going to equity ETFs for the dividend orientation. Now you can get income within fixed income ETFs.
Yeah, I mean, I certainly also have seen all the data about how retail investors at least seemed underinvested in fixed income coming into this period. So it's a catch-up move to, I think, grab some of that exposure, perhaps. Jerome, I'm interested in drilling down a little bit more what you're saying about this kind of two-sided risk. I mean, it seems like it could go in either direction. So either inflation remains stickier, the Fed has to be more hawkish, maybe the economy holds up better in that scenario, or all the leading indicators of a recession that we're seeing right now on display take hold, and we actually have a harder landing scenario. So how do you, I guess, remain with your weight balanced on both feet to be prepared for both those scenarios?
Yeah, it is a bit of a turntable economy and investment horizon for many investors, meaning they just go round and round and are sort of looking around at the data du jour for what the outlook is. We've already seen that to start the year. I think more holistically, what investors really need to be doing is pivoting and putting portfolios into position for maintaining some optionality. That means high liquidity and really having the option as we get more visibility, both in terms of where Federal Reserve's resolve is for fighting inflation long term versus the market conditions, and more importantly, the evolving evolutionary process that we see with regard to earnings and corporate earnings specifically. That's going to be, remove some clouds as we get further along into the year. So as we sit here right now, and as you put at the outset, the 4.5% to 5.5% that you're seeing in fixed income is doing two things. One, you're right, it's providing yield and income to those to investors in the portfolios in terms of safety and really insulating portfolios. But it's also doing the second thing, which is providing optionality, specifically to a group of investors who really haven't focused on fixed income for probably more than a decade. They're doing that through mutual funds. They're doing that obviously through ETFs, as we're discussing here. And in that resolve, we're going to see a really discussion, not in terms of just interest rate exposure, but in terms of sector allocations. And that sector allocation discussion is leaning in of itself to provide that insulation to fixed income. So when we find more clarity in terms of the reconciliation of inflationary expectations really being ultimately subdued by Federal Reserve policies, ultimately, when that happens, we're going to ultimately see some healthy opportunities emerge within not only the fixed income landscape, but the broader investment market in general.
James, you focus on the shorter end of the curve. Obviously, your fund is targeted that direction. You also hear a lot of folks who suggest, even if they're generalists, that is where the value seems to be, or at least the risk reward looks okay, right? Higher yields, keep duration low. You don't really know how it's going to go. But clearly, given the fact that the yield curve is so inverted, there's a lot of money piled into the longer end because that's how you get the inversion. Is that purely mechanical money? Is it because people really are at least assigning some high probability to a recession and therefore a dovish Fed down the road? What's your interpretation of that setup?
Well, I think it's a little bit of everything we've already discussed, which is investors traditionally have been underweight fixed income now, where we have the zero bound. Now there's yield back in fixed income, and it's now going to serve as a hedge in a portfolio for downside risk. So I think that's why we see, when we break down the flows that we're seeing flows into higher quality, to Todd's point, longer duration products, and then credit products on the front end of the curve. Those have been the lion's share of the majority of the flows that we've seen. Obviously, a smattering of flows into EM, high yield, but the big flows are into higher quality aggregate type strategies, and then barbelling that with some high quality credit in the front end where you can get these attractive yields, 5 to 5.5%.
And then within your slice, with this fund's target area of fixed income, what are you emphasizing most right now, and what are you kind of leaving aside?
Yeah, so our big, our number one trade right now is in bank paper in the 1 year part of the curve, A-rated banks yielding 5.25% to 5.5%. We like that it's a low vol play. We are legging into some duration though. So to your question before, obviously investors in fixed income generally are legging into duration. We're doing that in the front end as well. As we see sort of the light at the end of the tunnel here with regard to the Fed hiking cycle, we want to be legging in somewhat. That being said, we're being cautious on some of the credit spreads that I mentioned before. See some really high quality industrial names come with extremely tight spreads in the new issue market. To me, that starts to say, maybe it's time to step back from some of those names, concentrate on relative value in an active way in some of these cheaper names, especially in the bank paper that I mentioned before.
It's interesting because those same tight spreads that you're seeing, and you suggest they don't really have a lot of value in there, are being used as ammunition for people saying, look, the economy can't be in such bad shape, right? You have tight BBB spreads or whatever. So I guess, obviously, nobody knows the future, so we're trying to read what the clues are.
Yeah, no, agreed. And I think, again, we're staring down the barrel of some sort of slowdown. We know that, right? We don't know the extent to which it's going to be, whether it's a harder landing or not. But to that extent, there's not a whole lot priced in with regard to downside protection there. So, we'd rather stay in the new issue market where we can get spread concessions of 30 to 50 basis points, call it, in a new issue relative to secondary market paper. And then we're getting a little bit of pickup then to cushion us against the potential for spread widening on the back of a harder landing.